is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome to another episode of DeFi Decoded. I am Alex Tapscott here with Andrew Young. The big story in the news is the presidential debate, which happened last week, where Joe Biden, everyone on the Democratic side was hoping would show up and give a sort of an able performance, demonstrating that he was ready to maintain, the presidency and serve another term. And I think the consensus from the pundit class, and now even some elected Democrats, is that the performance was a disaster, and that if anything, this dramatically increases the odds that he'll actually drop out or be forced out of the race in favor of another candidate. Now, this isn't a politics show. We're not going to talk about, the candidates, but it is interesting to note, Andrew, that in the days leading up to the debate, the more popular Web3 prediction market, Polymarket, had the odds of Biden dropping out, I think, as high as 25%, and also had odds for all these other different kinds of candidates like, Michelle Obama and RFK, probably higher than polls would indicate, certainly for those who haven't declared and haven't even shown an interest in running for office. So the question here is, to what degree were these prediction markets kind of correct maybe in anticipating or pricing the risk a little bit better? And that's the thing that I'm really interested in getting your perspective on. I think since then the odds have gone up even higher, and the odds of Biden winning this election obviously have plummeted as the market factors in not only the lower probability based on the performance, but maybe the odds of him actually not even being in the race altogether. So I often wonder about this. There was a really interesting research paper that was done many years ago about the wisdom of the crowds, and about how, a bunch of people sort of together collaborating have a way of creating more wisdom than experts do. And I think the same basic concept can be kind of applied to markets, which is that, when people have got money on the line, they're doing the research, they're pricing the risk. And as Warren Buffett said, in the short term, markets are a voting machine. In the long term, they're a weighing machine. And you have to wonder whether or not maybe the market is a better mechanism for trying to sort of figure out the probability of things, and as a way maybe to then apply it to these other fields that we don't normally associate with, like politics. So first off, what was your take on all the betting action and all the changing odds and everything that's been happening around this election, and specifically around the debate? And then what do you make of that thesis?
Yeah, so the debate was obviously pretty interesting. I mean, both as a viewer, observer of U.S. Politics, as well as a crypto prediction market person. So what's interesting is that I would say this is like one of the first debates where prediction markets have been widely cited, both throughout this election, but then also actually throughout sort of the coverage of the debate. And so what's interesting is prediction markets and betting exchanges, things like Polymarket, on the crypto side, Betfair, as well as SX, have had a much higher sort of implied probability of Biden dropping out of the 2024 election than you would see in the sort of pundits discussing. So going into the debate, Biden was priced like a 20% probability of dropping out.
Yeah.
Which is kind of a crazy percentage if you think about it.
If you'd asked pundits, it'd probably be 0, right? Of dropping out. Maybe he dies of a heart attack or something, which, nobody wishes on anyone. But I'm just saying, the odds of him just volunteering seem almost 0, right?
Yeah, and what's interesting is a lot of the prediction markets, the sort of higher implied odds was dismissed by the mainstream crowd as just like a right-wing conspiracy theory. So for the most part, it was people just thinking that it was, these are just crypto guys who are more pro right-wing, and that's why they have, Biden has a much higher percentage chance of dropping out. A lot of people
how the Lakers always have bad odds because of all the homers, right, who are betting.
Yeah,
right.
Exactly.
Yeah.
And then on top of that, obviously there was videos going around of on Twitter as well as before over the last couple of months of Biden sort of stumbling in speeches. And the sort of official line from both the mainstream news as well as the White House directly was that these were AI doctored videos, or they were sort of cut up. And so that was part of the reason why people thought, for a lot of people going into this debate who've been sort of following the election closely, it wasn't actually that much of a surprise that Biden, couldn't really speak too well. And whereas I think for a lot of people, it was like a huge moment where, if you hadn't been following the election closely, you didn't realize to what extent, Biden's effectively aged over the last 4 years. But again, going back to this main point, the prediction markets did. So the prediction markets had a way higher implied probability of Biden dropping out. And throughout the debate, actually to start with the first 10, 15 minutes, right when Biden had his most sort of unintelligible answers, the prediction market odds of Biden dropping out actually went up to 40, 45%. They're currently sort of stabilized around 35 to 45. Because obviously in the last couple of days, Biden's had a couple better days. His whole family's come out saying, he's going to keep fighting, all that stuff. But it's just been a really interesting thing to watch, the divergence between what the market said, the betting markets, and the sort of mainstream coverage of the election. And those two have now kind of fully melded into one, where the mainstream coverage is openly talking about the prediction market odds and how that influences both the election and also how obviously the election influences the betting odds.
Yeah.
It's been crazy to watch, but I guess not overly surprising from our side as someone who's deeply entwined in the prediction markets, but then also the U.S. election. But a huge surprise for kind of the general public, I guess.
Yeah, completely. So I was looking up the book that I was referring to, The Wisdom of Crowds. I thought it was an essay. It was actually a book published in 2004, written by James Surowiecki, about the aggregation of information in groups, resulting in decisions that he argues are often better than could have been made by any single member of the group. And, it's funny, we're reading from Wikipedia, but Wikipedia is almost an example of the wisdom of the crowds, where a bunch of people, collaborating on these articles actually is a more authoritative version of the truth than what you'd find in Britannica, for example. So he talks about, this is from the page, the most common application is the prediction market, a speculative or betting market created to make verifiable predictions. And in my view, this is sort of, an example of prediction markets sort of winning or coming out victorious against the experts, which I think is really, really interesting as well. We talked a lot about prediction markets actually in Blockchain Revolution, the first book that I co-authored with my dad, where we talked about, future events, sporting events, election results, new product launches, the genders of celebrity babies, stuff like that. But also talking about prediction markets that could be applied to, a wide range of economic endeavors, using prediction markets around earnings releases, using prediction markets around weather events, right, as a way to hedge risk for farmers and agricultural companies and so forth. And I just feel like we're kind of just scratching the surface here for what their potential is. It's not just people who are, betting per se on the outcome because of the fun of speculation, but there's actual utility here. You may want to bet that Biden is going to drop out as a hedge against something else, right? That I haven't thought of, but I think there are lots of different, ways you might think about that. Maybe you think, a Trump presidency is, be bad for your business because, you import a lot of stuff and there's high tariffs or something. And so at least by betting against Biden, you're kind of hedging your risk, right? Something like that. Anyway, so I just think it's very fascinating. I'd love to use this as a chance to sort of segue into SX, which you rattled off as one of several prediction markets that offers odds in this area. And I want to transition because today you released your quarterly report, which, and I'm just sort of reading through it right now, looks really terrific, Andrew. And so kudos to you and the entire team. I think I saw that active bettors and volumes were up 50% or 45%. So really terrific, and congrats on the success. And I know there's more to come. Why don't you just tell us a little bit about, what's new at SX and how you're thinking about this issue too?
Yeah, totally. I appreciate the shout out. Betting volume was up 50% year over year on the quarter, effectively, with user growth, multiple sort of year over year user growth numbers of plus 100%. And this is all happening while bet mining incentives, which is kind of like liquidity mining for a prediction market, is essentially down 100%. So it's just like a much more organic, sustainable type of growth. The big thing for us, I mean, we can touch on this like in a more longer segment at some point, but the big thing for us is we've built our own application chain, which is SX Network, and we're actually going to be migrating that to effectively its own L2, which is pretty cool. And then we also built the app, or I should say the dApp, to be fully cross-chain. So we're sort of big believers in this vision that leading DeFi protocols and consumer crypto apps will have their own chain. Obviously, I've been talking about this constantly on this podcast, so it's not a huge surprise. But then also, I think dApps, like one of the big downsides of being on your own chain is you lose out on a lot of the distribution benefits of going on being these other chains. And so what's interesting with how we built it is we built the protocol into its own chain, but then we built the app so it can go fully cross-chain. And so yes, we launched our first cross-chain sort of deployment a couple months ago, and there's lots more sort of coming in the next couple weeks and months. And so it allows us to sort of like bring the app to where users already are, while sort of concentrating all of our liquidity on our main app chain.
Yeah, and so for people who are not deep in the DeFi space, basically with a lot of early new applications in the space, you offer ownership incentives to use the application, right? Turn your users into owners. Helps you to bootstrap the network effects too. In the early days, those rewards are high, and as they go down, some applications have seen users go away because the rewards are not as high, right? Like, oh, I'll move on to the next thing. Well, you're seeing the opposite, which is that the rewards are becoming more modest, still there, but people are using it even more, not because of rewards, but because of rewards plus utility. And I think that's the key differentiator. And this goes back to a conversation that we've had before about, building sustainable applications. And I think that betting clearly is a area where there's obvious product market fit. And it seems like right now, at least, sports is sports and it's chugging along, but it seems like the political side is very zeitgeisty at the moment. I'm wondering, like, you got a few months here before the election. Is SX going to be, announcing or unveiling a whole bunch of new betting markets around this event, and others like it? Because there's a lot going on in France and Germany and everywhere else in the world too, right?
Yeah, for sure. So the one challenge for us is we have this big migration coming. So we're moving from, like I said, we're moving the chain infrastructure. So we're sort of waiting for that migration to be done in the next couple of weeks before we do more long-dated markets. Yeah. 100%, we're going to have all the U.S. election markets, all sorts of different election markets. We actually had debate markets up for the debate. So like, would Trump mention Bitcoin, for example? Like we had those types of markets up for the debate. I think we had about 12 different ones. Actually, the most bet one was would Trump and Biden shake hands before the election. That had the most volume. They did not, no. And honestly, that one you could have just looked at prior, because they debated twice in 2020, and both times they didn't shake hands. So to me, that seemed like a very obvious, like, they're clearly not going to shake hands type of market. But anyways, so we have all sorts of cool novelty markets, crypto markets. Obviously, our core mission at SX is to drive down the VIG for sports betting down by over 10x from the industry standard of 5 to 7% to less than 0.5%. Sports betting is so ripe for disruption, just in terms of the insanely high costs that sports bettors are faced with. And what's cool with what we're doing with SX is we're essentially using the power of blockchain and DeFi to drive this huge reduction in cost, while also creating a far more fair and transparent and secure platform. Yeah. We are technically considered a prediction market, but again, we're more focused on the sports side because that's where we see the biggest impact for sure.
Yeah, very cool. I want to change the subject slightly because there's another piece of news out there that the MiCA rules in Europe, which are this comprehensive set of rules that came into place. I think they went into effect actually last year, but the stablecoin part of those that set of laws only came to effect recently, and then what we saw is Circle, the biggest U.S. domiciled stablecoin issuer, announcing that it was fully licensed in Europe to basically launch not only US dollar, but Euro stablecoins. Now, people have asked me, like, why are there basically no Euro stablecoins, or why the values are so like tiny? And I think a big chunk of the reason is that people just want dollars. It's the reserve currency, and it's 70% of all payments globally. So obviously, it's going to be the biggest share of stablecoins. But one of the other issues, apparently, is not apparently. One of the other issues is that until rates went positive in Europe, real rates, there was absolutely zero incentive to launch a stablecoin, because the whole business model is you hold assets on deposit, in effect, invested into treasuries, or European, I guess, securities, risk-free securities if they exist, and then your users, depositors, don't receive any interest. So you capture that net interest margin on the money you earn from the security portfolio versus not paying any interest. Now, if the securities are negative interest bearing securities, which did exist for a long period of time, then there's no point in doing that. So in the last 2 years, that's changed a lot, obviously, with rising rates. So now there's this economic reason for these things to exist. And now you've got new laws that provide some guidelines to do this. So in the past on the show, you've talked a lot about how, maybe we end up with this bifurcated stablecoin system where in the United States, people are using USDC and other sort of US-based dollar stablecoins. But outside of the United States, they might be using Tether issued, USDT, or maybe someone else comes along. And it's sort of similar or analogous to the idea of creating dollar deposits outside of American financial institutions back in the 20th century with the euro dollar. And I'm just wondering, how do you think, so you got this new law and USDC is now regulated in Europe. Does that change your thesis? Could USDC now become a global standard, or at least a standard for Europe and the US? Or do we still have this sort of not a two-tier system, but sort of a bifurcated system, basically?
Yeah, I think we still will have the bifurcated system, partly also because I think most of Tether's volume and activity is in Asia, and not Europe. So I could see USDC being essentially the US dollar stablecoin for the West, so Europe, North America, and then Tether sort of being the stablecoin of the East, for all of Asia, Middle East, all that type of thing. So I think that's kind of the way I would sort of divide them. Europe, yeah, I mean, it's interesting. You would have thought a couple years ago that Europe would have its own Euro stablecoin that became the main main stablecoin for Europe. But it's clear that US dollar crypto is actually the most dollarized segment of the economy by far, because it's the US dollar essentially has 100% market share. So I don't know. It's interesting to see. I think one thing that's also really interesting. I don't know if you saw this a couple of weeks ago, but Paul Ryan came out. Paul Ryan came out and essentially said stablecoin regulation is a geopolitical priority, because stablecoin issuers are some of the biggest holders of treasuries. They represent a new source of demand for treasuries, potentially one of the biggest sources of new demand. And obviously Paul Ryan's a fiscal hawk, and so he's worried that that there's not going to be demand for U.S. treasuries if with a $2 trillion a year deficit and just huge new supply of treasuries every year. So I mean, again, I don't really know how I guess the analogy to euro dollar is not totally right, because obviously euro dollar is more Europe based, whereas in this case Tether is more, I would say, Asia and Middle East based. So we could call it West dollar and East dollar is probably a better way to describe them.
Rest of West dollar and rest of world dollar.
What do you? Yeah, I'm curious what you think though about this. I don't know if you want to comment on the Paul Ryan. We sort of touched on it a while ago, but then also
I think we did. Yeah, I mean, so basically the idea is his view is if the government's going to keep borrowing all this money, they're going to have to find buyers for treasuries, right? And eventually natural buyers are going to get tapped out, I guess, right? Like Wall Street banks and investors and sovereign wealth funds and everybody else who buys these kinds of things. And the Fed shouldn't buy them. He probably thinks that's illegal, quantitative easing, but also by sort of internalizing the debt, you could drive up inflation, right? I guess is the theory. So you got to find another natural buyer for treasuries. Well, if people all over the world want access to dollars as a way to, to do transactions and to store and move value, this is a great way to do that. I agree. I'm not sure I agree with his thesis about like they're running out of buyers. There's always going to be, you can always just print money to buy your own bonds, which is something that's been happening for like 15 years. But I do agree that it's great to have another natural buyer for treasuries, obviously. And I think that if I was an American political leader, I would welcome and do everything I could to accelerate the dollarization of savings and payments in all around the world, because why not? It's good for the U.S. Economy. It's good for their security, for the dollar to be the global reserve currency, and it has since 1944, since Bretton Woods, when they basically made that the case. They just decided more or less unilaterally, because all other countries were bankrupt or destroyed, that they were going to be the global reserve currency. So this is a good way to extend that even further. On the question of Circle, I love Circle. I've known Jeremy Allaire for a very long time. He's been remarkably consistent and laser focused. I was on his podcast last fall. He and I had a long conversation about this exact topic. He's the CEO, by the way, for people who are listening. And what he wants is to create basically digital money utility for everybody in the world, a way for everyone to be able to use crypto, like to use blockchains as a way to store and move value, and then from there access a whole range of financial services, getting access to credit, savings, vehicles, investments, and so on and so forth. And he's executed on that, and he's gone through a lot of different cycles. So I don't know enough about MiCA to have a strong view on European regulations and how quickly this can scale and whatever. But I have a lot of confidence in the company, and obviously a lot of confidence in the asset class, in the tool itself. I mean, I think stablecoins are, one of the killer apps of this technology, self-evident by the dollar value outstanding, but also I think you're going to see more and more traction by non-crypto users. And if this rule helps to pave the way for that, then I think it's terrific. But I don't think it means that Tether is going to suffer as a result. My view is that we're still early, so all of this stuff just helps to grow the pie, right? And these both of these things can grow simultaneously. It's like there's so many countless examples of this throughout history. Like the Ford Motor Company made more cars made a bigger percentage of the cars in 1919 than they did in 1929. But by 1929, they were a much bigger company because more cars were being sold on the road, right? Like, you can go through computers and personal electronics and everything. There's lots of examples of this. So I don't think it's a winner-take-all market by any means.
Yeah, it's interesting. And Circle is actually, I think, kind of one of the most impressive comeback stories, because it initially started off, I think it was doing something else, and then it ended up buying Polionex for like $400 million, and then ended up having to spin that off, and I think they had some fines, and then they sort of like partnered with Coinbase on USDC after I think like a couple different pivots.
Yeah,
and then it's now become like probably one of the biggest companies in crypto, and I think they're going to be going, like, do you have any alpha on them going public, or what would that look like? Because we know from Tether that being a stablecoin issuer is one of the greatest business models ever, because essentially you sell a product. It's effectively like getting a free yield on billions of dollars of assets.
Yeah.
People buy stablecoins from you. You take the money and buy treasuries, and now that interest rates are 5%, you earn 5% on your balance.
Well, not only that, the operating leverage of the business is insane, right? Like you can have the same number of people with a $1 billion stablecoin as a $50 billion stablecoin. And in terms of other hard costs, it doesn't really change all that much. So, do I have alpha? I mean, I don't know if any of them I'm supposed to be sharing on the show, but they've indicated their interest in going public. I don't know what the company would be worth, but I think as any investor who's wants to get a way to get exposure to good quality business in the space that has exposure to growth in one of the main areas, like I don't know. I mean, I think it's a great story. That's my point of view, and it's true the company has pivoted a lot. But I've revisited this recently. I went back to the interview I did with Jeremy in 2015, and he said that he wanted to be the Google of finance, which is to say like a free utility that anybody can access in order to get the ability to move and store value in the same way that Google gives you sort of access to information, right? And now Google's not free. That's changed in the last decade. We've realized that if you're not the product, if you're not paying for the product, you are the product, and your data is being commoditized. And so there's other costs and problems with the Google model. But the point is that it did democratize access to information. The internet did, Web 1, Web 2. And this idea that he's had, and he said this a decade ago, was that he hoped to do that with Circle. So in a way, USDC, I think, is very much the embodiment of that initial vision. Whether or not the implementation has changed and it's gone on different courses and like what doesn't over the course of a decade, I think he stuck to the mission really clearly. So I think that's pretty cool. I didn't really have anything else today. I don't know. Do you have any other thoughts, Andrew?
Yeah, just one last thing on the Circle side. I was just reading. They actually did shift their legal home back to the U.S. I think they were offshore for a couple of years. And that was widely seen as like in anticipation of them going public. I actually didn't realize this, but they tried to go public through a SPAC about 3 years ago. At the peak of the crypto bubble at like a $9 billion valuation. That was also obviously like peak ZIRP era. So valuations were sort of inflated all over the place. And it looks like they were making about 200 million-ish per quarter, which seems like a lot less than Tether. I think I saw something Tether was making about $4 to $4.5 billion per quarter. Though I guess Tether is a lot more aggressive with their treasury. Like they have some percentage of their treasury in like Bitcoin and private equity, things like that. Whereas I think Circle's a lot more conservative. But yeah, I mean USDC is a $32 billion market cap, something like that. Mid 30s, I believe. So 5% on that per year is like $1.5 billion, which is a decent amount of money when you only need like less than 100 employees.
Yeah. Well, that's Tether. I mean, like Circle has got to be,
Circle's mid 30. Yeah. I'm sure Circle probably has more staff because I think.
I bet you it's got more people and it has more costs and it probably is paying. I don't know what it's paying.
So what's interesting?
Other things, but yeah, I don't have any insight into that other than to say like maybe it's not quite as robust looking as Tether, and it's not just because of the less aggressive treasury management, though I'll bet you that's a big part of it. I mean, remember do you remember this during Silicon Valley Bank, the collapse, how the peg, like Circle depegged, or USDC went from like $1 to like 82 cents or something. And that was entirely because of their very conservative, that's sort of the irony, like their very conservative approach, which was that they wanted to maintain a very high balance in like bank deposits, like so they could have liquidity, right, to meet any redemptions, which, you can't meet redemptions if you've got T-bills that are locked up for 6 months or a year or whatever, and interest rates go against you. But what happened in that case was that because they had money on deposit at Silicon Valley Bank, they were at risk of losing everything if the bank went under and the government didn't backstop it. So they, along with others, got bailed out basically. So that's all to say these are not risk-free businesses, A, but and B, that they're probably earning a little less because you're probably getting a little less from a bank deposit than you are from buying a bond, right? Based on my own personal experience, it's not by much, but it's a little bit less.
Yeah, it's interesting too. And one other thing to point out is Coinbase actually owns like 3.5% of Circle, and they valued it at $51 million in their in last year's, I think, annual report.
That's all they valued it? Sorry, that's all they own is 3.5%?
Yeah, I think they sold off a big portion of it, and maybe Circle raised more cash, because initially it was a 50-50 joint venture. So it seems crazy that they only own 3.5%.
I'm gonna check that. Just we'll put it in the show notes if it's any different. I mean, who knows? But
and they only valued that 3.5% piece at $51 million, which is like an implied valuation of $1.5 billion for Circle, which at this point is like comically low. That's like a 1 times revenue multiple we don't know what their earnings are like, but
assuming we think the revenue looks similar, right?
Yeah. Well, no, exactly. So, anyways, moral of the story is that's maybe a bullish catalyst for Coinbase as well if Circle does indeed go public. I think like one of the things, I mean, we talked about this earlier, but I think one of the things that's most interesting about Coinbase is the fact that they have this venture, Coinbase Ventures, which is like a VC fund, and besides kind of strategic ownership stakes like Circle and whatnot, they have like one of the best portfolios, or they're widely seen as having one of the best portfolios in all of crypto. And so it's kind of something to pay attention to as crypto. If crypto continues to go up, that could be a huge potential catalyst for Coinbase. So we shall see.
Well, no doubt. Well, I mean, we talk about that business a lot, but these companies, sort of the survivorship bias, like if you can get it through these cycles and figure out how to capture value in the space, you can become a very successful business as a result. I think that's it for me today. I mean, those are the 2 big news items. We're going to see, I mean, in a week's time, we may know whether or not prediction markets have clairvoyant capabilities, because I'm pretty sure we're going to get an answer one way or the other on the question of President Biden. And the wisdom of the crowds. But I like this topic. I think we should revisit it. Hopefully we can do a deeper dive, Andrew, on SX and the quarter that you had, and also sort of what's coming post-migration, and dig into these ideas a little bit more. Another shameless plug, you did write an excellent paper on prediction markets, which actually became a chapter in a book called Digital Asset Revolution, which was published by Barlow Books as a collaboration with the Blockchain Research Institute, where you talked about all this kind of stuff. We talked about politics and finance, and even using prediction markets and governance, which is something that has not yet really captured or taken hold, but may yet still. So, there's a lot of intellectual food for thought here around prediction markets. I think that this election has helped expose that to a more mainstream part of the population. And I think it's only going to grow from here. So if you want to learn more about that and other stuff, tune in to DeFi Decoded. And by the way, for those who are listening, make sure to give us a like and a follow on wherever you get your podcasts. And follow the 9 Point YouTube page as well. Tons of great content, not just on digital assets, but on a zillion other things too. That's it for this week's episode. Andrew, great to chat as always. And until next week, we will see you later. Take care.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.